July 20th. Beijing launched a coordinated rescue of China's stock market after a brutal sell-off erased nearly 10 trillion yen in market value this month, triggering fears that the country's artificial intelligence boom was rapidly transforming into yet another speculative bust. The response was immediate. State institutions moved into the market, billions were deployed. Officials rushed to stabilize sentiment before the damage spread even further. But the intervention itself raised a much bigger question. If such extraordinary measures are required to keep markets standing, what does that say about the strength of the system underneath? Because this wasn't simply another bad trading session. It exposed growing concerns about confidence, valuation, and whether China's latest AI-driven rally was beginning to unravel. The rescue effort unfolded on multiple fronts. State-owned investment firms China Reform Holdings and China Chengtong Holdings announced that they had deployed around 60 billion yen, roughly $8.9 billion US, into domestic shares and exchange-traded funds. The buying did not stop there. 5 major insurers joined in with additional stock purchases. Several state-owned enterprises announced buybacks and increased dividend payouts. Then came signs of even broader government-backed intervention. 23 exchange-traded funds favored by Central Huijin Investment, a key part of China's sovereign wealth fund, attracted approximately 96 billion yen in net inflows within a single week. During the closing minutes of Monday's trading session, turnover in so-called national team ETFs surged, helping the CSI 300 reverse an intraday decline and finish the day up by 1.5%. On the surface, the market had stabilized. But the speed and scale of the intervention suggested officials believed the situation had become far more serious than the headline numbers alone indicated. That urgency becomes easier to understand when looking at what happened immediately beforehand. The CSI 300 had just suffered a brutal week, falling 5.3%, its worst performance since October 2022. The Shanghai Composite dropped 5.8%. Even more dramatic was the collapse in technology shares, with the Star 50 plunging almost 17%. Traders unwound leveraged positions at the fastest pace seen since the 2015 through 2016 crash as weakness in crowded artificial intelligence stocks spread across the broader market. The pressure was no longer confined to a handful of speculative companies. It was expanding across the system. And that is precisely when Beijing stepped in. But this is where the deeper problem begins to emerge. China's stock market has already experienced several dramatic cycles of boom and bust. A debt-fueled rally during 2014 and 2015 ended in a historic crash that triggered heavy-handed government intervention and restrictions on selling. Chinese shares rallied again during the pandemic before falling sharply amid technology crackdowns, the property crisis, and weakening economic growth. More recently, government encouragement fueled enthusiasm for strategic industries such as semiconductors and artificial intelligence. That policy support helped create fresh concerns that another speculative bubble was developing. The latest sell-off, therefore, was not viewed in isolation. It fit into a much larger pattern that many investors had already witnessed before. That history explains why confidence remains fragile. Investors continue to question whether China's stock market functions like other major international markets. Beijing has the ability to abruptly change regulations, restrict trading, or direct state institutions to purchase shares. Questions also persist regarding corporate transparency, the reliability of financial disclosures, weak shareholder protections, and whether political objectives take priority over investor returns. State intervention may succeed in stabilizing prices temporarily, but it can also make genuine market valuations increasingly difficult to determine. When government buying becomes a major force supporting prices, investors are left wondering whether they are looking at market value or policy value. And that uncertainty can become just as damaging as falling prices themselves. Recognizing those concerns, China Securities Regulatory Commission Chairman Wu Qing met with 8 investor representatives in Beijing. During that meeting, he pledged to strengthen regulation, improve the transparency of listed companies, protect investors, and maintain an open and fair market. Those commitments were clearly designed to reassure investors following the recent turmoil. Yet the central challenge remains unchanged. Confidence is not restored simply because additional money enters the market. Investors remain divided over whether this latest intervention marks the true bottom of the sell-off or merely slows the deflation of China's newest market bubble. That uncertainty continues to hang over every trading session. But while Beijing was attempting to stabilize financial markets, another flashpoint was escalating far from the stock exchange. On July 20th, a Philippine Marine was injured during a confrontation with the China Coast Guard at Second Thomas Shoal, ending more than a year of relative calm around one of the most dangerous flashpoints in the South China Sea. The incident occurred near the Sierra Madre, the aging Philippine Navy vessel intentionally grounded on the shoal in 1999 and maintained as a military outpost. What followed demonstrated just how fragile the situation had become. According to the Philippine military, a Chinese rigid-hull inflatable boat carrying 8 personnel approached the Sierra Madre, circled the vessel, and recorded photographs and video. 2 Philippine rubber boats then moved to drive the Chinese vessel away. Manila stated that its personnel acted calmly and non-confrontationally. However, it claimed Chinese Coast Guard members responded by striking a Philippine sailor on the head with a wooden baton. The injured sailor required medical treatment, while the Philippine boat reportedly sustained damage during the encounter. Beijing presented an entirely different version of events. The China Coast Guard stated that its vessel had been conducting a routine patrol near what China calls Ayungin Shoal when 2 Philippine boats approached dangerously, surrounded it, and rammed the vessel. Chinese authorities claimed Philippine personnel attacked first using paddles and long poles, forcing Coast Guard officers to employ what they described as reciprocal countermeasures. Both governments released video footage that they said supported their respective accounts. 2 narratives, 2 competing versions of the same confrontation. Yet, regardless of which account is accepted, one reality remained impossible to ignore. The confrontation became physical. Although sticks, paddles, and batons replaced firearms, the incident demonstrated how rapidly encounters between small vessels can escalate. Second Thomas Shoal has remained a persistent source of tension ever since the Philippines grounded the Sierra Madre in 1999 to reinforce its territorial claims. China continues to claim sovereignty over the shoal despite it lying within the Philippines' exclusive economic zone. A 2016 international arbitration ruling rejected the legal basis for China's sweeping claims, but Beijing refused to recognize that decision. During 2023 and 2024, confrontations intensified as Chinese vessels attempted to block Philippine resupply missions through water cannons, collisions, and boarding actions. In June 2024, a Filipino sailor lost a thumb during an especially violent clash in which Chinese personnel seized equipment and damaged Philippine boats. A provisional resupply agreement later reduced tensions, but the latest incident suggests how fragile those arrangements remain. The timing adds another layer of significance. The confrontation occurred just before Chinese Foreign Minister Wang Yi was scheduled to visit Manila for the China-ASEAN Foreign Ministers meeting on July 22nd. Beijing has emphasized its support for ASEAN cooperation and regional stability ahead of that gathering. Yet the return of physical violence at Second Thomas Shoal threatens to overshadow those diplomatic messages. More importantly, it highlights the continuing risk that what begins as a confrontation involving small patrol boats could eventually trigger a much wider crisis involving the Philippines and its treaty ally, the United States. Meanwhile, another challenge continues to develop inside China itself. The country's pipeline of utility-scale wind and solar projects now dwarfs the rest of the world. China had approximately 262 gigawatts of solar capacity and 251 gigawatts of wind capacity under construction in June, according to Global Energy Monitor. Both figures have increased since the end of 2025, indicating that renewable expansion remains strong despite an apparent slowdown in official installation data. New electricity pricing rules introduced in June 2025 encourage companies to accelerate projects ahead of the deadline, temporarily bringing installations forward. Although only 60 gigawatts of solar capacity had been installed through May, Bloomberg forecasts additions reaching 255 gigawatts during the full year as completions accelerate during the second half. But even here, another structural problem appears. The larger challenge is curtailment. Wind and solar facilities are increasingly forced to reduce output because the electricity grid cannot absorb all of the power they generate. This problem is particularly severe across Western China, where renewable resources are abundant but located far from the country's largest industrial and population centers. Beijing is responding by constructing long-distance transmission lines while encouraging energy-intensive industries to relocate westward. Yet, existing transmission networks currently carry approximately twice as much coal-generated electricity as renewable power. That raises concerns that even as grid capacity expands, coal could continue receiving priority unless clean energy gains greater access to those transmission systems.